you all for joining us today for our Third-Party Risk Management Regulatory Expectations to Know webinar. My name is Jessie Redmond, and I will be your host. On your screen, you should see multiple widgets that you can use, including Ask Question, Media Player, Slides, Related Content, Speaker Bio, Request Demo, and Help. If you're not familiar with our webinars, all the widget boxes are resizable and movable, so feel free to move them around to maximize your screen space. At the bottom of your screen in the toolbar are icon buttons you can use to show and hide those widgets. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner of the widget. If you experience any issues or have technical questions, you can use the Help widget or submit them along with any other questions through the Ask Question widget. Don't worry, we do capture all questions throughout each session. We will be answering some during the webcast, but those that we do not have a chance to answer live, we will address with you via email. Today's live session is eligible for 1 CPE credit. If you wish to receive this credit, please remember to answer all of the polling questions that will appear on your screen during today's presentation. You will also be sent a follow-up survey link 24 hours after the live session that will need to be completed in order to receive the CPE credit. With us today, we have Hillary Dewhurst, VinMinder's Head of Third-Party Risk Education and Advocacy. She will discuss sensible strategies and advice for reviewing your program in a more professional manner and teach you to take the stress out of audits and exams, which are normal and expected occurrences for every third-party risk management program. You'll see a link to a copy of today's slide deck, a link to our website, a link to our samples library, links to our third-party risk management audit or regulatory exam checklist, the third-party risk management lifecycle toolkit, vendor risk management exam or audit preparation guidebook ebook, and state of third-party risk management survey, as well as a link to our library of additional resources, all within the related content widget. With all that being said, I would like to hand it over to Hillary. Hillary, the floor is yours.
Well, welcome everyone. We have so much to cover in a very short time today. But to give you an idea of what we're going to be doing, we're going to start off with some basics about the regulatory landscape, what some of these terms mean, and then we're going to move on to help you connecting the dots between regulatory guidance and your program. We'll also teach you how to look at your program like a professional, like an examiner, so that you can see some of the items they might be looking for during an exam. We're going to show you how to self-audit your program and teach you what to do when issues come up. And then we'll wrap up with some best practices and some mistakes to avoid. So let's jump on in. Now, if you've joined us for any of our previous webinars or read any of our information, you'll know that we always like to remind everyone why third-party risk management is so important. However, for the purposes of today's webinar, we're going to just jump to that last bullet because it's the law. So for many industries, third-party risk management is actually the law. So here you'll see a list of industries, the most common ones that depend on third-party vendors. It's pretty extensive, and you'll notice that most of the industries and company types are those that we use every day, both in our personal and professional lives. Remember, these are only the top industries, and there are many more that depend on third-party vendors. But if we think about it, consumer business, energy, financial services, manufacturing, technology, media, and telecom all have third-party risk management rules, laws, and regulations that govern them. But to really understand this, we have to start with understanding the regulatory landscape. And I know, speaking from my own personal experience, that when I started in third-party risk management like 100 years ago, I kind of thought that rules, laws, and regulations were all sort of interchangeable lingo. And I'm sure that many of you out there are in the same boat. So a great place to start this conversation is with those basics. Now let's start with laws. So for any of you old enough to remember Schoolhouse Rock on Saturday morning, you're going to think about that little old bill sitting on Capitol Hill waiting to become a law. And it was a great jingle to help us remember our civics lessons. But the long and short of it is that laws must go through the legislative process, which includes sponsorship and debate, passage through Congress. And then they have budget hearings and finally executive approval. Once a bill becomes a law, it governs everyone equally. Regulations, on the other hand, are not subject to legislative process. Regulations are created by executive departments and agencies. And because those agencies and departments are appointed positions, the current administration has significant influence over those groups. That's why proposed regulations and regulatory agency appointments are often subject to a lot of political challenge. As a matter of fact, the OCC still only has an acting commissioner because President Biden's first pick was too controversial and his second nomination didn't make it for the OCC, but is now the vice chair for the Fed. So that's a bit of an example. But keep in mind, the administration and the regulators do not make proposed regulations in the dark. As a matter of practice, they allow the public to see the proposed regulation and to provide comments. Sometimes those comments are made by industry leaders, and that can affect the final regulation. But once that regulation goes into effect, it has the force of law because essentially it's implementing a law. But regulations only affect those who are dealing with the enforcing agency. So one thing to note here is just because you may not be subject to the regulatory guidance of a specific regulator, that does not mean your program won't be affected by that guidance. So for example, today's accepted best practices for third-party risk management are direct reflections of previously regulatory guidance that was developed by the financial services industry. Now we come to rules. Rules are usually individual components of a regulation. Usually each rule is going to address a specific part of the regulation. So for example, Dodd-Frank had over 400 rules, and each rule can be considered a law. We also can regard rules as individual sets of how to comply with the regulation. And that brings us to guidance. Guidance is an all-inclusive term that could reference supplemental material provided by the agency to clarify existing rules. And that could be all of the bulletin statements, the Q&A, the advisories, etc. One thing to keep in mind is that guidance is meant to be helpful, but guidance in and of itself is not binding. So you can see the quote here that guidance does not have the force and effect of law, and the agencies do not take enforcement actions based on supervisory guidance. We're going to talk a lot more about guidance later, but this brings us to our first poll question. Jessie?
And this brings us to the first poll question of the day. You should see the poll question now in the slides area. If you have any issues, please feel free to send us a message using the Ask Question widget, and we will be happy to assist. As a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This poll question is, how do third-party risk management regulations and laws influence your third-party risk management program? Directly, we are a regulated industry. Indirectly, we have customers that are regulated and expect us to comply with the same regulations. In influence, we aren't directly regulated but follow best practices. We don't currently do third-party risk management. We're not sure. And Hillary, it looks like we have some time to answer one of the questions that has come in so far from the audience.
Great.
And that question is, can you give an example of a law that applies to third parties for all industries?
You know, there is a bunch of laws that apply to everyone when it comes to the workplace. And so by default, those would apply to your third parties as well. One that I can think of in particular would be the OSHA Act, which is about safe workplaces and conditions for all employees everywhere. So all of your third parties, no matter who they are, would have to follow that. There are different regulations by industry. So to say that there's just one that covers it wouldn't be accurate, but there are many, many laws. Another one is the FTC regulations on false advertising that would apply to just about any business anywhere, and by default would apply to your third parties.
Thanks everyone for answering that poll question. Here are those results. Also, you may have noticed reactions such as a thumbs up or heart coming across the screen. If you find this feature distracting, you can turn it off by clicking the 4 arrows in the top right corner of the slides widget, which will expand the slides to full screen and no longer show the reactions. Before we move on, as a reminder, in the related content widget, you'll find our third-party risk management lifecycle toolkit. Within the toolkit, you'll find an ebook, infographic, PowerPoint template, and a printable one-page PDF. All these resources go into depth about the entire life cycle to help you manage third-party risk effectively. Hillary, let's continue with the presentation.
So now we know the basics and the differences between laws, regulations, rules, and guidance. But that still doesn't mean it's always easy to sort out. You've got to remember that there are thousands of laws and regulations that apply to third-party risk management. And regardless if your industry is actually regulated, there are laws that are going to apply to your third parties. And I'd be remiss if I didn't mention that there are also many state and local laws that may apply to your third-party practice. As we move through this conversation, we're going to focus on concepts of regulatory requirements more than the actual regulatory agency, just because there are so many and we would never have enough time to go through each one. So let's take a look at some samples. So let's take a look at some regulatory highlights from different industries. We're going to start with financial services today because I know we have a lot of bankers on the phone. And you know what? There are a lot of regulators in this space, but some of them all have common themes in their regulatory requirements. The first of which is the board of directors and senior management's involvement, accountability, and oversight, that the institution should plan how they're going to manage the third party and ensure that they have the resources to do it. There's the principle of proportionality, so the highest risk activities and engagements have the most robust third-party risk management activities, and that means that critical activities require the most robust management. And financial institutions must ensure that they have adequate due diligence and monitoring for the duration of their relationship. Moving on to healthcare services. So the regulatory requirements in this space are really all about the security and privacy of personal health information and how the vendors may be able to interact with personal health information data. The requirements here are very prescriptive and really talk about each type of relationship to the organization, covered entities, for example, and these requirements are very prescriptive when it comes to vetting third parties with access to that data. So once a vendor has access to data, it becomes a covered entity. Now we come to insurance services, and taking a look at insurance, the requirements here are that the organization has effective due diligence in place, and when selecting a provider, they have evidence to demonstrate appropriate due diligence was executed. So now we can see each industry is not wholly different from the others, but this is why it's so important to actually identify, read, and understand the regulations that govern your industry. But what about non-regulated industries? Let's take a look at some general laws and rules that govern everyone. So there are a lot of examples I could list here, but I've really included the ones that I thought most people would be somewhat familiar with. So let's start with Sarbanes-Oxley, which really serves to improve the accuracy and reliability of corporate disclosures, including audit requirements and how records should be kept and stored. We also have the FCPA, which forbids bribery and corruption. And to that, add that we have the OECD, which was implemented in 1999 to reduce political corruption in developing countries. I can remember actually when it was not considered all that unusual when a company was going to go in and do business in a developing region that they may have made payments to local or tribal authorities for access, etc. Well, that's no longer legal, and it hasn't been for 20 years. We also have standards, so ISO standards that prevent bribery. So regardless of whatever industry you're in, those anti-bribery requirements pretty much apply to everyone. Getting into a little darker area, we have the California Transparency and Supply Chain Act, which is really all about preventing human trafficking and modern slavery. This particular one is about disclosure and making statements about what your organization does to prevent such practices. So moving on, we have Title VII, which is an anti-discrimination law and a civil rights law. And this applies to organizations that have 15 or more employees. There's also the Wages and Fair Labor Standards Act, which is basically the minimum wage requirement and requires paid overtime. It covers child labor laws, etc. And it's very important to make sure that your third-party vendors comply with this law. I've added the California Consumer Privacy Act here as an example of some of the local laws that can apply to you even if you're not in that jurisdiction. In California, for example, if you have customers or clients that are in the state, you still have to comply with that law. And just a note about privacy laws, California may have been the first, but it's certainly not the last, and there have been many new laws that have been enacted and many more that are on the way. So it always makes sense to know which of those laws apply to you and how they apply to your organization and your third parties. And then finally, we have OSHA, which is the Occupational Safety and Health Act, and hopefully prevents dangerous working conditions for everyone everywhere. So we've just looked at a very small sampling of the many, many laws, standards, etc., that are out there and must be considered both internally and for your third parties. As you can tell, there are a ton of laws, regulations, rules, and standards out there, and there's no way we can cover them all in this hour. But a good rule of thumb is to understand and remember the common themes of third-party risk management laws and regulations. So I've provided a list here. I'm not going to go through all of them because of time, but I want to pick out a few. So one is protection of consumer rights. Consumer rights may not always be as obvious as safety or civil rights, and they can vary depending on the country you're in. But for the purpose of this conversation, we're going to talk about the United States, and as a consumer in the U.S., you have the right to safe products and services, you have the right to be informed, you have the right to choose, and you have the right to be heard. We can think about protection of critical infrastructures, the environment, natural resources, safe and sound business practices and decisions. But let's talk about the last three bullets here because they've really evolved out of issues like the financial crisis of 2008 and more recently the pandemic. And those are effective risk management, transparency and disclosure, and oversight and accountability. So with oversight and accountability, it's really important to make sure that there is someone accountable, that someone has their name on it if something goes wrong. And I want to really make sure that you are paying attention to these common themes because you can literally go through any business practice you have and think about these concepts. You can ask yourself the questions such as, does this business practice potentially violate a consumer right, or is what we are doing considered effective risk management? If you think in those terms, it's always going to serve you really well and can be even more effective than memorizing a whole regulation. Now, we've covered a lot of material to help you hopefully by regulations. And keep in mind, you can always memorize a regulation. But if you come from the mindset that these requirements, regulations, and laws are really just common sense, ethical behavior, and safe and sound business practices, if you operate from that principle, you will usually be in line with all the laws and regulations. And it's also good to remember that wherever you have a specific vendor risk, there's usually a regulation or law addressing that risk somewhere. When it comes to regulations, you need to understand who your regulators are, and you need to understand what the requirements are. You can do that by reading the guidance, and you should probably read it more than once. Keep in mind you don't have to memorize the guidance or the regulation, but you should be able to identify those central themes that we talked about. Now remember, guidance is not the law, but it is considered a best practice. So your examiners are going to use the guidance as a roadmap to evaluate your program. So you should read it and follow it as closely as possible. Now the big question here is, can you stray from the guidance? Well, if your organization is actually meeting the requirement, but maybe in a way that is different than the guidance, you should be prepared to articulate it, provide documentation, and prove that you're actually meeting the guidance. So what happens when regulations or guidance changes? Well, it does all the time. And it's not something to get totally worried about because it's not like it happens overnight. So the regulators have to publicize the proposed changes and provide time for comments. And as soon as the proposed changes are made public, the best thing for you to do is review the content and identify what changes might be necessary in your organization to be able to meet those requirements. And it's always important to have a good working plan, but also remember that you aren't expected to comply until the changes are made effective. And as the regulations are finalized, they make the announcements and they give an effective date. Usually there's at least 90 days to get to compliance, but it could be more depending on the number and the extent of the changes that are being made. All right. I know we have a lot of bankers on the phone today, so I just wanted to touch base on what is happening with the proposed interagency guidance on third-party relationships, or more likely what is not happening. Just some quick background. Last July, the FDIC, the Board of Governors, and the OCC came together and said, hey, we're going to put out a single universal guidance, and it's going to replace all the individual guidance for each agency. And, it was kind of a mixed bag. The guidance that they were proposing was based off the OCC's guidance, which is the most prescriptive of any of the three agencies. And there were a lot of changes like, hey, now all third parties are going to be in scope. And, that could cause a lot of extra work for everyone. But there were also some good things in there, especially for smaller financial institutions that may be struggling. So they really emphasized the appropriateness and the ability to outsource portions of your due diligence, for example, or collaborate with other banks on due diligence. So the long and short of it is the comment period closed last October. There were a ton of comments and a lot of pushback. And so far, we just have radio silence. So I would just keep your eye open for that. Certainly we'll let you know if something happens, but for now, it just seems to be stuck. So another way to help manage these changes is to be aware of what the emerging focus of the regulators would be. So there's a lot going on in this space right now. For example, cybersecurity has been hot. It's been hot for a few years. President Biden's administration has done a lot of work with this in 2022. There's a lot going on there. That is never going to be out of focus. The increased attention to environmental, social, and governance, transparency reporting is also a big one, as would be focus on issues such as modern slavery and human trafficking. So if anyone's familiar with the Uyghur Forced Labor Prevention Act that's here in the United States, the California Transparency and Supply Chains Act, these are all trying to prevent those human rights abuses. Another big one is fintechs as third parties. So making sure that we are looking at fintechs in the same regard as we would any other vendor. And then, of course, that extended enterprise risk, those third, fourth, and so on parties that can affect your products or services are a big focus as well. I just wanted to provide two examples of some enforcement actions. These had happened rather recently. On the large financial fine side, we had the OFAC and FinCEN charged Bittrex, which is a virtual currency exchange, with not having appropriate anti-sanctions measures. And then, of course, they had some third-party risk management issues when they hired someone to manage that function for them, and they weren't very comprehensive. So they got charged both $24 million by OFAC and $29 million by FinCEN. So that is one of the largest cash fines ever, and that just happened in October. And then at the beginning of this month, T-Mobile got an enforcement order, but was really about making sure they were taking action, and that was about improving their vendor risk management program. So just some quick examples of how enforcement actions are levied.
Our second poll question of the day is, if faced with an audit or regulatory exam today, which area might be a weakness in your program? Understanding the requirements, applying the requirements, action to meet the requirements is not adequate or consistent, documentation or other proof may be insufficient, compliance to the program, oversight and accountability, none, we are all good, or you're not sure. And Hillary, I have another question here that I think we could go ahead and answer.
Okay.
And that question is there a resource to see all regulations for a specific industry?
I wish that there was. We do know of there are plenty of services out there that will sell you, subscriptions so that you can see all the regulations for your industry. But in terms of free resources, there's really not any one particular one I can point to. What I can tell you is that if you do a quick Google search and you say all regulations for, third-party risk financial services, you'll get a lot of information that comes back. There's many, many companies that write about these things, and there's also advocacy groups by industry that do publish these types of articles. So your Google search is probably your best bet, and if anything changes on that, we'll be sure to let you know. But I hope that helps.
Thanks so much, Hillary. We will be closing this poll in just about 15 seconds, so please go ahead and submit your responses. Thank you. Okay, here are those results. Thanks again, everyone, for taking the time to answer the poll. Before continuing, I would like to direct your attention to our related content widget, where you will find our Vendor Risk Management Exam or Audit Preparation Guidebook ebook, and our Third-Party Risk Management Audit or Regulatory Exam Checklist. Both of these resources will provide helpful information on what you need to know to prepare for an exam or audit. Hillary, I'll pass it back to you.
All right, let's talk about oversight, and we're going to start with the different roles in the oversight structure. So first of all, we have our regulatory examiners, and their objective is to review and evaluate your program and determine if it complies with the requirements. If it doesn't comply, they have a variety of enforcement actions to address those insufficiencies. But many times, they will provide a series of formalized warnings requiring changes before they get to the most severe enforcement action. Of course, it just depends. If the issue is very egregious, they may go directly to the most severe action. It just really depends. Now you have your auditors, which can be internal or external, and their job is to review the program to identify any inconsistencies or gaps that could potentially result in regulatory enforcement action or other issues. Their job is to be very neutral and objective so they can report the issues to leadership, and believe me, they do. But once those issues have been reported, they're also on the hook to keep monitoring and make sure the issues are addressed. And then finally, you have your board and senior leadership. And actually, these are the ones that are accountable for third-party risk management at the organization. So they need to approve the policy and assign the roles and responsibilities. But most importantly, they're also responsible for setting the tone from the top. And it's not unusual for examiners to cite senior leadership for having inadequate oversight. So let's move on and get in the nitty-gritty about what examiners and auditors really expect and what they're looking at. Okay, we're going to spend some time here because it's really important to understand these concepts and apply them when you're reviewing or implementing your third-party risk management program. So the components on this slide have specific considerations that can really apply to literally every single part of your third-party risk management program. So let's start with the 4 components. We have awareness and understanding, application, adequacy, and consistency. So the first thing that many examiners will look for is there general awareness and understanding of the third-party risk management requirements across the organization, and more specifically with those responsible for executing the requirements. So are the right requirements identified? Do we know the standards we're managing to? Do we know what the rules are? And are decisions about the program informed by the requirements? And most importantly, do the people at the top understand and communicate those requirements correctly, because that flow of knowledge has to start at the top. So once the requirements are identified and understood, now we want to see if they are actually applied. The place we're going to look for those requirements to begin with is in the policy. So that means, hey, you need to have a policy. And within the policy, there should be a defined scope detailing the situations to which the standards apply. So we also want to look at, do contracts identify and enforce the requirements, and where and how are the requirements applied? After we identify and apply the requirements, we have to make sure that the process and tools being used is effective, right? So do the processes and tools perform as intended? Are they adequate? And it's not just about the adequacy of processes and tools. It means that the people responsible for applying those processes and tools are performing their roles effectively. So do they have the right skills and expertise? But the last thing we look for is consistency. First are the processes and actions. Are they consistent with the policy? Are the processes executed all the time? Some of the time? Maybe depending on the person. And if they're not consistent, are exceptions documented? So maybe there's established timelines or routines for accomplishing specific requirements. Are those timelines being met consistently? Are things happening on time? And is the quality consistent? So consistency is imperative, because great processes get you nowhere if they're only followed some of the time. Okay, so we talked about awareness, application, adequacy, and consistency. However, to prove that any of those components are as they should be, we need evidence, right? So you probably have heard me say it. You'll hear me say it all the time. It's basically, if it's not documented, it didn't happen. And I'm not just saying that because I'm a difficult person. But I say that because examiners and auditors are not there to take your word for it. So what kind of evidence might they be looking for? Well, we've provided a list. But, you know, each of these pieces of evidence, again, should be consistent. They should be available. They should be well organized. Let's move to accountability. This is a biggie. If there's a systemic issue with the framework, your auditor or examiner is going to find out who's supposed to be accountable, even if that goes all the way to the top. So when we think about accountability, another aspect of it is to make sure that if something goes wrong, people are held accountable and there's actions taken, right? And it's managed appropriately. So for example, let's say you have a repeat offender, maybe that business line owner who never does what they're supposed to or doesn't do it on time and comes back with, hey, my bad, but they keep repeating the behavior. And that's because there's no incentive for them not to. And that would mean you have an accountability problem. So compliance to the program, it should be measured and monitored, just like accountability. We want to make sure that if we have rules and requirements that we're putting out there, that we can prove that they are being adhered to. And we also want to look at communications when it comes to compliance, because auditors and examiners will want to make sure that you're effectively communicating those compliance requirements. And then finally, there is oversight, and this is probably the cherry on the top of the sundae. They're going to want to look at that policy, and they're going to want to make sure that roles and responsibilities are clear and that there's appropriate reporting and review of third-party risk management program. And this is why you always hear that the board should be getting regular reporting about the program, because they are responsible for oversight. So we want to make sure with oversight that we do have somebody watching the store. But another really important element of oversight is making sure there are separations of duties to prevent any unacceptable risk-taking and to limit opportunities for fraud or other illegal practices. So let's talk about how you can apply this and audit your own program. So now you know what you're looking for. You have a good idea of kind of what those expectations are, and you can actually go out and audit your own program. Now, make no mistake, it takes a lot of education and training to become a professional auditor, and the path to becoming an examiner is a very long one. But that doesn't mean that you cannot audit your own program, and reviewing your program is actually a best practice. You can review it formally or informally, but you should review it. And a good way to go about this is to break your process down. Take a specific component of the third-party risk management life cycle. And this way you can do a deep dive and really explore how compliant your program is. And if you do identify any issues, you should formally plan to treat them by creating remediation plans with a timeline and accountability. You want to document all of it and go about closing the gap. So let's get into that sample. So this is a very high level of what you can do when you're going about a review. So first of all, I took 2 critical vendors and 1 high-risk vendor, and I'm going to examine the due diligence process. So the first place I would start is my policy. What does the policy require, and who is responsible for those requirements? Maybe your policy says that due diligence must be complete before contract execution, so we need to make sure that it was. I would look at the processes that are used to meet the requirements and see who's responsible for each part of the process. From there, I want to look at where the process is consistently executed and if the processes were managed according to the requirements. So what is the evidence that demonstrates the effective completion of these processes? Now, you'll consider if there are any exceptions. Exceptions might be in the form of the process not being followed, or all of the elements were not considered before a decision was made. Or you may have an exception that required an approval, and you'd want to look to see if the approval was given by the appropriate person and if we have evidence to that effect. Now, we're going to look at the information from the vendors. Did they fill out all the due diligence questionnaires as they were requested? Were the documents collected and were they sufficient? Do we have a documented subject matter expert review, and what did it say? Were there any issues or findings that they needed remediation before the contract? Or were there any items that needed to be included in the contract, and were they? Another consideration of documentation is the documentation organized and properly stored with the vendor record and not just hanging out on someone's desktop folder? From there, you might want to look at the cadence that was set for ongoing monitoring, including risk and performance reviews. So suppose you have a requirement that says the annual risk review occurs within 12 months for each vendor, but one of your reviews didn't happen until 14 months. Or as another example, maybe you have an existing vendor that's going through due diligence as part of an annual risk review. Did you review the vendor's performance before initiating the review? Were there any issues related to risk or performance that should have expanded or altered your scope of due diligence? What about new and emerging risks? Those are all considerations for your review process. And any time you find a gap or insufficiency, you should note that because you will need to go back and look at root causes later. It's also important to look at more than one vendor and more than one risk rating. And I usually tell people to focus on critical and high risk because that is where most of your auditors and examiners are going to focus. But from time to time, it doesn't hurt to look at how your moderate and low risk vendors are going through the process as well. So as you are going through your review, it's really important to think like a regulator. We've provided a list of questions you can ask about literally any part of the process, but keep in mind that even though you may know why a certain action was taken or handled in a different way that's outside the process, your auditor or examiner will not know that. So keep in mind they are going to be looking at documentation and that evidence to identify where things don't line up. So you really should take the same approach. Now, one thing I can say about making sure that every exam or audit goes well is to train the stakeholders to always act as if an audit or an examiner is coming the very next day. And that means no shortcuts in documentation, addressing issues with a sense of urgency, sticking to the process, and documenting exceptions. It also means that you're following up when items are delayed or late and that you're addressing poor quality, even if that means you have to escalate up the management chain to ensure issues are addressed. As you go through this, keep in mind it's completely normal to find gaps or inconsistencies even when you think your process is running perfectly well. And once you do identify an issue, most likely it's because of inconsistent execution or your documentation is disorganized or maybe there's not enough documentation at all. But another really big issue is that the policy is out of touch with what the real process is. And this can be a really huge problem when policies are written to be aspirational and not really reflecting the current state. So keep that in mind as you move through your review. Even if you have been reviewing your program informally, when you come across an issue, it's advisable that you document it. You really need to take the time to figure out what the root cause is and why the process failed or what that gap was. So from there, you need to think about remediation and get it back on track. Once you have your plan and your findings, make sure you take it to the appropriate stakeholder, whether that's your management or risk committee or a third-party committee, because you want to make sure that issue gets closed. You know, it's totally true. You're not going to find any issues if you don't look, but ignorance is not always bliss, especially when that examiner finds an issue before you do. That's why it's really important to document the gap and start executing the remediation plan. And that means keeping track of your progress as well. If an examiner or an auditor should discover that you knew about an issue and didn't treat it, that becomes an even bigger issue. Auditors and examiners expect that your organization is going to self-monitor to a degree and that you take risk management seriously. The day will come when you get a notice of an audit or regulatory exam. And the first thing is don't panic. It really is a normal part of a healthy business process. And if you've been auditing your program, maybe you found a few issues, don't scramble to try and get them all fixed right now. If you've been capturing the issues and you have plans in place, you can submit them with your audit documentation. The truth is that auditors and examiners do expect to find issues and realize that we all have our problem vendors. We've all got them. So in a best case scenario, your exam may result in a few observations or suggestions for improvement because even if you think that you have a perfect program, you need to expect some findings or observations. Now we have our last poll question of the day. Jessie?
Our next poll question is, do you perform informal audits of your third-party risk management program? Yes, at least once a year. Yes, but not consistently. Partially, only auditing specific processes. No, or not sure. And Hillary, let's go ahead and answer another question from the audience.
Okay.
And that question is, can you explain the separation of duties?
Yes, the separation of duties is a business concept that largely evolved out of accounting practices. And it's really the concept of having more than one person to complete a task. So it's basically a control. For example, we would have on signing a check, either there would be two signatures or the one submitting the expense account can't turn around and write themselves a check. This concept can be expanded out into third-party risk management to make sure that, for example, the person submitting an inherent risk assessment, for example, is not necessarily the one assigning the risk rating or confirming the risk rating. And the reason we have this is to make sure that no one person can, defraud or sabotage or misuse information or compromise security throughout the process. So that's what separation of duties is about. I hope that's helpful.
That's great. Thanks, Hillary. Just a reminder, if you have any issues submitting your poll answers, please feel free to send us a message via the Ask Question widget, and we will be happy to assist. And this poll question will be closing out shortly. And here are those results. Thank you to everyone for answering this question. It's very interesting to see everyone's answers. Before we move on, I would like to mention that our annual State of Third-Party Risk Management Survey is now live. Your voice matters, and we'd love to hear how you and your organization have been managing third-party risk. You can find the link to complete the survey in the related content widget. Let's continue with the presentation. Back to you, Hillary.
We have been through so much information today, but I want to leave you with some mistakes to avoid and some best practices. So first of all, don't take an ignorance is bliss approach when it comes to your regulations. You are responsible for understanding them and proving you can meet the requirements. We also don't fail to put a critical eye on your program. You need to audit it. You need to be objective and really dig in and see where there's gaps or issues. Inconsistency with the application of your program and policy requirements can result in big findings and issues during the exam. So make sure you're consistent. And don't have a passive attitude about improvement. Don't wait until something is totally broken before you go about making your program better. Not being transparent in audits or exams is also something you want to avoid. And don't wait for an audit or exam to get it all organized. Well, if you walk away with anything today, I hope that you understand how important it is to take time to identify and read the regulations specific to your industry. And you want to keep on top of any changes to those regulations, including changes in rules and guidance. Consistently review your program using that auditor or examiner mindset, like be neutral, be objective, find the problems. Make sure when you do find problems that you record, report, and manage those issues or weaknesses. And ensure that adequacy, consistency, and evidence of your activities should be daily priorities. Always take the mindset that the regulator's coming the next day. When you do get scheduled for that audit or exam, prepare for it and make sure you are organized. When you take time out to follow your processes and manage documentation as a daily practice, getting ready for an exam is really not that difficult. And keep in mind that even the best programs have findings in audits and exams, even if they're just suggested. So expect something to come out of it. And no matter what, always be transparent and cooperative. Don't try and hide the ugly spots in your program because auditors or examiners are trained to find them. And finally, if something comes up in an audit or exam that doesn't feel right, it's okay to speak up. This doesn't mean you're being uncooperative, but rather taking your concerns to the management chain so they can make the right decision. So I really want to thank everyone for attending today's session, and I hope you're walking away with some excellent information you can put into practice when it comes to understanding regulatory expectations and addressing issues in your program. And with that, I'm going to turn it over to Jessie for more information and Q&A. Jessie?
Great. Thanks so much, Hillary. Before we dive into more questions and answers, I would like to thank everyone for attending. I would also like to thank Hillary for her time in sharing some really important information. As I mentioned earlier, we have an annual State of Third-Party Risk Management Survey where we collect data every year on how organizations are managing third-party risk, top struggles, and much more. We'd love to hear from you, but even more importantly, this survey helps to deliver information on the industry's best practices, challenges, trends, and more to you and your peers. Take the survey today and gain access to your complimentary white paper in January that will feature results and analysis from our experts. You can find the link to complete the survey in the related content widget as well as the slide on your screen. On your screen now, you will see our upcoming webinars. December 6th, our tips and tricks for document collection, a key aspect of your vendor due diligence. And on December 13th, our third-party risk management best practices for 2023. We hope you will be able to join us for those sessions. A link to register for those is in your copy of today's presentation slides. Let's now go ahead and answer some more questions that have come in during this session. Okay, Hillary, the next question is, how can I make my vendor comply with a specific regulation if they aren't in a regulated industry?
You cannot make your vendor do anything, but a vendor who is supporting your products and services should understand that there are requirements they have to meet to retain your business. So one of the best ways to make sure that that's clear right from the beginning is to explain the requirements that you need them to meet and put it in your contract. If you can't get a contract because you're just signing maybe a service agreement, then it just at least verbally explain your expectations and document it. Most vendors are going to understand that even if the regulator doesn't touch them directly, they still need to comply. I hope that answers that question.
That's great. Our next question, how will I know which vendors the auditors or examiners will look at?
Generally start with your critical vendors right off the top. Most of the audits and exams I've been in, they immediately pull that critical vendor list. It's also good to look at your high-risk vendors. Pay special attention to vendors that have access to data. That is a huge springboard for vendors because there's so many issues that can result from those relationships, not just cybersecurity, but privacy as well. So start with your critical and high-risk vendors.
Perfect. Next question. We don't have a vendor management policy but have regulated customers. Is that going to get us in trouble with the regulators?
It depends. Generally speaking, if you're not directly regulated, again, this is kind of like the first question, you're not reporting into them, but there are many regulatory agencies that by right of having, like a bank, they can enforce jurisdiction over the vendors as well. So just for the sake of having good business practices and being a good vendor, I would really recommend that you get a third-party risk management policy together.
Perfect. Next question. We don't have an internal audit team and have not ever had an audit, so does it still make sense to self-audit?
Yes, and I'll tell you why, because it's only a matter of time before you have an audit. A lot of times the first year or two of a program, you may not see an audit. It just may not make sense. But I guarantee you at some point you will have an audit. And even if you don't, the purpose of auditing your own program is to make sure you're not missing anything and close those gaps. But yes, it does make sense.
Great. Next question here. Are private equity firms considered part of financial services for purposes of this discussion? And are private equity firms subject to regulatory requirements for third-party risk management?
Okay, so private equity firms in general are regulated by the Securities Exchange Commission, or the SEC. The SEC does have quite a few third-party risk management requirements. A lot of them are around cybersecurity and access to data and customer privacy. There are some exceptions for private equity firms where they could be exceptions to these rules. They're very complex, and I can't answer that on the call, but in general, the SEC does regulate private equity firms.
Perfect. Next question. Is SOC compliance a regulatory requirement for SaaS providers?
So just to be clear, we have regulatory requirements. Those are by those regulatory agencies. SOC, for example, is a more or less a standard, right? So it's a standard operating controls report. And whereas it is a type of independent third-party review, there are other types of third-party reviews, standards and certifications that can meet the qualification to have that independent review. So SOC in and of itself is not a requirement, a regulatory requirement, but many times it would be a regulatory requirement, say, for a financial institution to ensure that any vendor they're sharing data with, for example, has that level of certification or has a satisfactory SOC report. I hope that makes sense.
That's great. Next question. Is it recommended or not to begin implementing changes or processes for upcoming regulatory requirements before or after it's required?
So this can be really tricky because, for example, like the interagency guidance we talked about in the presentation, there's a lot of changes in there, and they can be really big for some companies. And it makes sense, if nothing else, to do a gap analysis and say, hey, if we had to meet these requirements today, where would we fall short? Now, some of these things may seem like good common sense, like, hey, we need a better due diligence process, or, we need to include our fintech partners as third parties. You could go ahead and start working on that implementation. The problem is, especially with some of these big, very sweeping changes, is that what they say initially may not be what it is in the final state. So, it's really hard to give specific guidance on that. I think the best thing you can do is do a gap analysis, understand where you fall short, and put together a plan that said, if we had to get into compliance, how would we do that and how long would it take? It's also really important to remember that even when guidance becomes finalized, there's usually a pretty generous compliance window. I mean, 6 months is the norm. Sometimes it's longer than that. So it's not like the minute they say it's effective, you're going to have to comply, but do get your plan together so you can if you need to.
Great. Thanks so much, Hillary. Unfortunately, that is all the time we have left for questions today. Thank you, Hillary, for taking the time to address some of those that came in. Any questions we did not have time to answer today, we will address with you offline. We would like to thank you all for attending and hope you found today's session valuable. A big thank you to Hillary as well for her time and great content. You can ask even more questions inside of our third-party think tank, an online community that is dedicated to third-party risk professionals and free to join. Just because today's session has ended doesn't mean the conversations and questions must. Post your questions at thirdpartythinktank.com and see what your peers have to say. In the community, you'll find thousands of free educational resources related to third-party risk management topics, including regulatory expectations to assist you. If you'd like to become a member of Third Party Think Tank, you can register on this site or shoot us an email and we'll get you registered and send you a link to set your password. We did record today's session, and that recording link will be provided to you in a follow-up email that you will receive tomorrow afternoon. Also in that follow-up email will be the survey link for you to request the CPE credit. On behalf of Inminder, it has been a pleasure. Thank you and have a great rest of your day.